Well, I started in the investment industry from the sell side in the 1980s at Warburg Securities. So I was a broker, trained as an analyst, and it's 12 years ago that I moved to the buy side and became an investor. In terms of my influences towards value investing, there are different types of value investors. There are the intellectual value investors who've studied it and realized this is the way to make money. You don't overpay for your good investments, or if possible you buy them at a discounted price. So that's the intellectual side. There are the others that might have met somebody that influenced them, and they're probably the other people, and I think myself and in fact my colleague Philip Best were both probably value investors in our lifestyle before discovering that it existed in investing as well. Well, I think like everybody, Warren Buffett, Charlie Munger, it's great to listen to their wisdom, their common sense talking. I read basically a lot of the great investors and find a lot of wisdom in what they say. I think that to be a good investor, you've got to be, for your whole life, having been very curious, going out, finding information. And in terms of the qualities you need to judge a company, you've probably got to be at the same time enthusiastic and skeptical. No, I mean, we don't hedge. We invest in European equities. Currency-wise, we are invested 80% euros. We've got some Swiss franc, we've got some sterling. We don't do macro. We don't know where the Swiss franc's going. We don't know where sterling's going, and therefore we don't actually find a lot of value added in hedging those. We build our holdings with conviction. So we will take a small position in the company when we have an idea, and then we will build it as we research that idea, go into greater depth, and our conviction rises, which means that we've got some holdings which are 5, 6 or even 7%. We have a good concentration in our portfolio of the top 20 holdings because the top 20 represent 60% of the portfolio, but we also have a long tail. That long tail will be constituted of ideas which we're building up and maybe some of the ideas that we're reducing. We're very long-term investors, we're contrarian investors, we catch falling knives. We invest in companies that are, we're pretty deep value, and therefore we'll be investing in companies at tough times. We're catching the falling knife. We don't necessarily have a catalyst, and therefore we may be investing in the company for 3, 4 or even 5 years' time. So a very long investment perspective, which means logically our turnover is very low. We're at around 25%. We invest in small and microcap companies, so illiquid companies. So we do keep a small cash buffer, one to pay back our investors when they want their money next week, and secondly to be able to take opportunities when there's a stock that's being sold off in the market, and it's a way to park our cash waiting to make an investment. But we won't sort of build up 25 or 30% of cash anticipating that the market's going to fall. Our expertise is bottom-up stock picking, not on anticipating where the market might go. We don't find them sitting behind the Bloomberg. We go out and see, we estimate around 350 companies a year, so a lot of company visits. We have proactive conference calls with company management. The great thing is we do small and microcaps. When you do smaller microcaps, you meet the CEO of the company. So we'll go and see the CEO in the company headquarters. We'll often go visiting the factory, visiting the facilities, seeing the product, etc. However, what we might do behind the Bloomberg is the screening. There are 9,000 quoted companies in Europe, so we will do a certain amount of screening, but we do it once a week on a Friday. We've got a team of analysts that are helping us with the screening and finding a list of companies we should probably go and have a look at. We're contrarian investors. We are looking to accumulate a portfolio of good companies acquired at a low valuation, a discount to intrinsic value. So what we're trying to do is we're trying to see those companies that have been sold off by the market, that are on sale, that are available for purchase at a discounted price. We try and understand why the market is negative on this stock. On smaller companies, a small piece of bad news can take the stock down 30, 40, 50, 60% even. So we understand all the negatives, or try to understand all the negatives the market is saying about a company, and then we go and visit the company. And we'll compare what the market is saying and what we perceive as being the reality when we visit the company. So these company visits is a core part of what we do. Definitely the favorite metric is sum of the parts. So we try and separate out a company to all its constituent parts. Either there are obvious parts in which the company communicates, different divisions, but often we have to go looking for those parts on which the company doesn't communicate. We know there are areas which are the cash cows, the clients that have been around for a long time that generate a lot of business, and the pricing is good and the margins are high. There are other areas which is developing into new products, new countries, which will generate growth for the future, but have lower profitability. So we try and make a sum of all these different parts to see what the intrinsic value of the company is today. Otherwise, our other metrics are quite traditional. We will often screen for low price to book value. We tend to use the classical price to earnings ratio. It's out of fashion. Everybody's looking at price to free cash flow, price to EBITDA, other multiples. We like the price to earnings ratio. And as we're contrarians, we quite like looking at the current price compared to the past peak earnings. In other words, if we're buying a company whose share has fallen in the stock market because earnings are disappointing, we will look what the current market price is compared to what they were generating in terms of net profits when things were fine. We're probably better buyers than sellers. When we're buying into illiquid companies, if you've made a mistake and the stock's falling, the likelihood if we start selling that day, we're not going to be able to sell our shares for several days and the share price will push it further down. So we're a little bit like a private equity company. We take an investment decision, we'll build up progressively, however, as our conviction grows, but we're not going to decide company's made a profit warning today, it's not in line with what expected, let's get out, because you can't. We're generalist. We know bits and pieces about a lot of sectors. We're not experts in any particular sector. We're looking for, from a bottom-up perspective, companies that are undervalued. We tend to look in countries or sectors that have underperformed, rather than trying to anticipate this sector is going to be very strong in the next few years. There are a number of sectors in which we have generated probably more value, such as the manufacturing sector. We have tended not to invest in banks, in pharmaceutical companies, in biotechs, which are not really adapted to our value investing approach.